Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending January 13th, 2023. Thank you all for tuning in and subscribing to this channel as well as our podcast, InvestTalk. Now, this week I'm going to title the video, Recession Ahead? Market says no. And, that's really the message. You have to listen to the market. Everyone can prognosticate whatever they want. But as I always say, the market's going to do what the market's going to do. It doesn't care about your opinion. And you need to listen to the market because that's the most important opinion. Not what you read somewhere, what you heard on a video, or what mind you made up, right? It's about the balls and strikes that are being thrown at you every single day. And you need to judge, what message that's sending, okay, to you. Now we'll take a quick look. I like this dashboard. I think I'm gonna do this every day now this year, every week this year. And here's the 1 month on the top left and the top middle. You have the U.S. market. You see over the last month, growth is down about 2.4%. Large cap value up about 1.2%. But the main message here is really the small caps. You can see how much they have outperformed so far over the past month, and that is pro-cyclical, meaning the market is telling you that things domestically are improving versus overseas. Because most of those smaller cap names are very reliant on domestic, the domestic economy. And so if they're improving, that's a bet that the domestic economy will improve as well. Whereas a lot of those large cap names, they're multinationals, and they have a lot of business overseas. And so that is often a worry. And what's interesting is that, the dollar is down, right? The dollar is down. I'll pop over here. And usually that's a headwind for those tailwind for those multinationals, because now they're the denominated currencies that they're earning their business in, euros and yens and all the other currencies, those are appreciating. Those are typically tailwinds when the dollar is weaker, but you're not seeing that. Okay, so there's obviously always multiple factors you have to consider, or that the market is considering. But this is a clear message with the dollar weakening that, hey, our domestic economy is going to improve, and maybe that's better exports, right? And we'll talk about that here in a little bit. But that's important to look at these type of things. Now over the past month, the large cap growth has been dragging down the domestic market. You see this red for the U.S. Overall, the U.S. market is down slightly for the month, but you're getting some strength in China and the reopening, some strength in Australia. That was mainly probably because commodity prices higher. Same with Brazil here. So you can see commodity price countries doing well, China reopening doing well, Western Europe doing fairly well on top of that. So some more recovery probably in the European market itself. So some interesting crosswinds there. From a sector perspective, this is also showing cyclical stocks of about 2.25% over the past month. Rate and currency sensitive sectors down about 1%, really dragged down by technology here. But you can see industrials positive, energy up 4.3%. Still the best sector over the past month, followed by financial services, and then communication services. And so that's where you're at now. And the defensive side, down 2%, dragged down by healthcare 2.5%, utilities 1%, and consumer defensive 1%. So pretty interesting to see what that movement is like over the past month. Now the past week, you can see here in the middle, pretty solid up week consistently. The yield curve, that continues to be inverted out to about a year. So it's showing you that within the next year, the Fed is likely to cut rates. So that's that. We'll dig into some economic data. Not a big week for economic data, not a lot, but pretty consequential, which is the CPI. That was down month over month for the first time, really since July. But if you look at here, you can see over the past month, annualized, we're about 1.8% on the CPI. So we're back to pre-COVID levels of inflation, and that's with the slowing economy, obviously. Now, year over year, still at 6.45%, but somewhat arbitrary, right? Because what's most important is what's happening today, not based on what happened a year ago. Okay, obviously you had the Ukraine crisis really kick up inflation in the first half of the year on top of the spending that we've talked about. But that's kind of rolling off now, and you can see the core CPI year over year down to 5.7%. Export prices down 2.64%. This might be with a weaker dollar. Obviously, we can lower our prices because those foreign currencies are more valuable, and so that's what you're seeing here. Certainly a drag on inflation more broadly. Import prices that ticked up a bit as expected, kind of the opposite of that. When the stronger dollar, it's a weaker dollar. That means those foreign products are a bit more expensive, and that's what you're seeing here. Consumer sentiment ticked up to 64.6. Also, oil prices, gas prices down. That's certainly helping the consumer feel a little bit more positive of what's happening in the broader economy. Now, the CBO Fed Watch tool, we're at 93% that we're going to get a 25 basis point hike in February after that CPI data that basically came in line, a bit lower than expected, but pretty much in line. And that is certainly why you saw rates down this week. You saw that from a 75% chance now to up to 94. We're basically going to get that. Now the question in March, it was a week ago or a month ago, it was kind of split between, are we going to get 25 and then 50, or are we going to get 25 and a pause? Now and this is for the March meeting. Now it's a 78% chance we're going to get another 25 basis points, but now the weighting on the alternative to that is clearly in the camp of a pause, meaning the February hike could be the last one. So that's what you saw in the economic data and the reaction within markets. Now, let's get to the broad market. Here's the SPX. We broke above the 200-day moving average on Friday. Did we do that? Let's see. Did we do that on Thursday? Closed at 39.83, and the 200 is at 39.84. Yeah, so we did not close above it on Thursday, but we did on Friday. So we'll see if we'll get some follow through on Tuesday. Remember, the market's closed on Monday. The NYSE, the broader indices, that broke out. I talked about this, about the 618 retrace that we kind of tested. Actually, let me get this more precise here. We got to get the real high. There we go. So we found that resistance, pulled back to the 50-day moving average and climbed it. And now we've broken out above. So there's a good chance. What's that next level? Let's go to, for some reason, it doesn't put the 75 retrace automatically, but that's the next level in the NYSE. So there's also some other levels. Here's one, which is right where it's at now, basically. So, to say the market couldn't turn next week, I think it could turn to the downside. I do expect more volatility in this first half. So any rally is likely to be met with a downside because the Fed doesn't want the market to really break out. So I think they'll continue to be hawkish if the asset markets remain relatively buoyant, because the economic data, while deteriorating, I think they're fine with. And so, they're looking still of those year numbers. They're not really looking at the last 6 months clearly, which means that they are going to remain relatively hawkish, which likely means some additional volatility going forward. IWF to the IWN, growth to value, that continued to be weak, which means value outperformed for the week in general. Now you had the VIX also breaking down to new lows. That was something that I was watching here. That's also a positive for markets as a whole. You had the bond market, junk bond market, that one going to basically remaining relatively robust, relatively strong, which shows you that the market is not pricing in a recession. Kind of what I talked about at the top of the show. The cyclical sectors are doing well. The credit markets remain strong. So I see no real issues there. And certainly a big part of that is that weaker dollar. So the market, while the Fed is remaining hawkish, the market is becoming more downbeat on higher rates. You see that with the SHY continuing to rally, meaning, hey, near-term rates are likely to come down. Gold also breaking out. Gold is just crushing so far this year on that weaker dollar. Here's GDX continuing to do well. GDX to the GLD, that remains robust. SLV to the GLD. This is the one area where you got a bit of a pullback, but remains in an uptrend overall. So I could see silver outperforming going forward. The energy market, that remains in an uptrend. Just a pullback in December. Didn't break any major support levels, so nothing to worry about on that front. The real story was the materials. So China reopening and a weaker dollar obviously means higher commodity prices, not just energy, but the material sector as a whole. So that had a pretty nice week. And then industrials, also a sector that remains in a solid uptrend. The ARC ETF, get a bit of a boost here, but overall remains in that downtrend. You had the commercial banks come out with earnings on Friday, and they were actually pretty good. Here's the IA to the KBE, still remains robust. We'll see what the investment banks say on Tuesday. We get the two big ones, Goldman Sachs and Morgan Stanley, reporting earnings on Tuesday. Now the XLF in general, just strong. You look at the major stocks. JP Morgan, a little bit disappointing earnings, but the market reacted positively and ended up nicely higher. Same with Bank of America, same with Wells Fargo, and that is a positive when the banks or the market's reacting positively to bank earnings. I also want to touch quickly on XLY to the XLP. So this is the consumer discretionary, the XLY to the consumer staples, XLP, and you can see that in a nice uptrend and now up a bit month over month. So, that is continue to price in a more positive economy. Everyone's talking about a recession, and I still think we have a recession this year. The market is saying, no, we're probably not going to have that, or at least a major one soon. And if we do, it's all priced in. It's kind of what the market is telling you. So, that's where we're at. Near term, you got to expect bullishness until you get some type of reversal. While we're into resistance, do we chop to break higher, or do we get some major reversal day? And until we get that, I'm not going to get too negative on the markets as a whole. A big test will be the high from December. If we get past that, maybe the first half volatility is behind us. But until you get that, you really have to stay open, have an open mind, stay nimble, and continue to call balls and strikes. Don't get too married to one narrative or another. All right. So that's where we're at. Thank you all for tuning in. Reminder that the contents of this video are for educational purposes only, and it should not be construed as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a good weekend.